More cultural badness from the finance sector. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Today, we take a look at the latest from the Royal Commission into Financial Services Misconduct, which has recommenced its hearings, and with a focus on financial planning. Financial advisors provide advice on a range of areas of consumer finance, investing, superannuation, retirement planning, estate planning, risk management, insurance and taxation. And ASIC says that between 20 and 40% of the Australian adult population use or have used a financial planner. That means that around 2.3 million Australians over 18 have received advice or are receiving advice. A number of issues have surfaced in recent years, including charging fees for no service, advice not provided in full, the provision of inappropriate financial advice, as well as improper conduct by financial advisors and the misappropriation of customers' funds. There's been a massive growth in the number of financial advisors to more than 25,000, up 41% from 2009. And there are more than 5,800 financial advice licenses issued to firms in Australia to provide advice. What you may or may not know is that the top 5 players in financial advice in Australia are the Big 4 banks and AMP, which together have 48% of the $4.6 billion in annual revenue. And moreover, 30% of advisors work for one of the 4 major banks, and 44% work for organisations in the top 10 by revenue. So it's a very concentrated industry. Then there is a long tail of smaller organisations, with 78% of firms operating with less than 10 advisors. And the average advice licence covers 34 individuals. Now, there have been a number of significant scandals relating to the provision of financial advice in recent years. Townsville-based Storm Financial encouraged investors to borrow against their homes to invest in index share funds in a one-size-fits-all model of advice. And Storm collapsed in 2009 with losses of more than $3 billion. Around 3,000 of its 14,000 clients had suffered significant losses. And many of the investors were retired or were about to retire and with limited assets and income. And in fact, some lost their family homes or had to postpone their retirement. The founders were found to have caused or permitted inappropriate advice to be given and had breached their duty of care under the Corporations Act. Specifically, the one-size-fits-all model of advice failed to take into account individual circumstances, which led to devastating consequences for the individual investors. They'd focused too much on the profitability of the business as opposed to the best interests of individual investors. ASIC worked with a number of major players for customers who'd made investments through Storm. CBA, for example, undertook to make $136 million in compensation to many CBA customers who'd borrowed from the bank to invest through Storm and who had suffered financial losses. That was in addition to the $132 million CBA paid under the Storm Resolution Scheme. ASIC looked at settlements distributed by Macquarie Bank to Storm investors, leading to a revised agreement where the bank agreed to pay $82.5 million by way of compensation and costs. And the Bank of Queensland agreed to pay $70 million as compensation for storm-related losses. A second scandal involved Commonwealth Financial Planning Limited. A whistleblower revealed allegations of misconduct within the firm to ASIC in 2010. It was suggested that some advisors were encouraging investors to invest in high-risk but profit-generating products, which were not appropriate. Some clients or even switched into alternative products without their permission. And in addition, some client signatures were forged. When the GFC hit in 2008, thousands of clients, many of whom were nearing or in retirement, lost significant amounts as a result of the misconduct. More than $22 million was paid to clients for compensation for receiving inappropriate financial advice from 2 financial planning advisors initially. But later it became evident that misconduct was much more widespread, so CBA implemented a second program of compensation relating to advice from advisors. Their Open Advice program had conducted more than 8,600 assessments of which more than 2,500 required compensation, in total of $37.6 million. So turning to the hearings, first up was Peter Kell from ASIC, who described the fee for no service problem.
Could you explain to the Commission, in ASIC's view, what it means for a financial services entity to charge fees for no service?
Fees for no service is a term that ASIC came up with to describe a situation where a customer is paying an ongoing service fee to a licensee, but where the service attached to that fee, most notably regular advice reviews, the service is not provided. And as you've indicated, this is an issue that we've identified as being widespread across the industry.
So typically, what is a consumer supposed to receive under an ongoing services arrangement with a financial advisor? You've mentioned a regular advice review.
In ASIC's opinion, that's the key service. If you have an ongoing relationship with an advisor, you would expect, we believe that you would be getting regular advice reviews. There are many different versions of the sorts of ongoing service arrangements that we've seen across different licensees. Some of them also provide other services such as newsletters or brochures or other information, access to websites and so on. In our view, the key offering though is the advice from the advisor.
And how do financial advisors typically charge for and receive ongoing service fees?
The fees are typically deducted automatically from the customer's investment account balance without the customer having to activate the payment. This is changing to some extent now under the future of financial advice reforms. There is an opt-in requirement, so that now every 2 years the customer must be actively engaged around renewing the relationship if that's what they wish. But prior to that, there were fees that could be deducted automatically over a long period of time. In our view, if ongoing service fees are improperly applied, then they do, unfortunately, have some similarities with some of the more problematic aspects of commissions, being that they are recurring, they can be invisible to the customer from a practical point of view, and there may be no clarity around what exactly the customer is getting or supposed to get in return for these payments. If properly applied, it can be different, but if improperly applied, and that's happened on a widespread scale, they do have some distinct similarities.
And what can you say about the quantum of annual service fees charged by financial advisors?
The annual fee, in ASIC's experience, varies quite considerably depending on the licensee, but also the size of the customer's account. It tends at the lower end to be around $500 or so dollars. A more common amount would be around $2,000 on an annual basis, and we have seen examples where it is considerably higher than that. I mean, if it's charged on as a percentage of assets, it could go up to quite high amount, up to, for example, in a small number of cases, $20,000.
You're talking about on an annual basis?
On an annual basis.
Thank you. And when did ASIC detect that fees for no service were being charged by financial services licensees?
We received a breach report in August 2013 from one of the large financial advice providers, as a result of that, it was apparent to ASIC that this may exist in other entities. We received other breach reports subsequently. We made a public announcement that we were looking at this in more detail in 2015, and that generated some subsequent breach reports. I think it's safe to say that the new FOFA requirements around opt-in and also the annual fee statement led to some financial services licensees to look more closely at what had been the practices in their businesses, and that may have triggered the breach reports.
Just, can you explain to me what was the content of the breach report? What was the nature of the breach as described, for example, in that first report of August 2013?
That was a breach report from ANZ, who have subsequently entered into an enforceable undertaking with ASIC, and that was that they had identified that across their financial planning business that they had been charging customers a fee without providing the annual advice that the customer had been led to expect they would receive.
The future of financial advice reforms, or FOFA, has tightened the rules, but the fees can be significant. And as we'll see, some players simply took the fees to bolster their profits. Next up was AMP, and we heard over the subsequent day or so that on more than 20 occasions AMP failed in their duty to notify ASIC of a number of potential breaches. Despite the fact that AMP was aware of a range of issues, they simply allowed the practices to continue.
You know, we're going to come in some detail to the fact that AMP did not notify ASIC in relation to these potential breaches. You know that there was a significant delay in giving notification to ASIC, and that a number of the communications given to ASIC were false or misleading.
That's correct.
And are you apologising for some misconduct in relation to that?
Yes.
Okay.
Yes, we are.
So this is a notification given pursuant to section 912D on the 15th of January 2009.
Yes.
And you're familiar with it, obviously? You've looked at it, you've exhibited it to your statement?
I have had a look at it, yes.
And it gives notification that clients were being charged an additional fee for service where what they were paying was dialed up above base commission.
That's correct.
And that when they were then, when the advisor or planner left and the client was transferred either to another planner or alternatively into the bowler pool, that they continued to be charged this dialed up commission but no services were provided to them.
Yes, I understand that's the basis of the breach.
All right. Well, that was the notification that was given
Yes.
in 2009.
Yep.
And what's explained as to the reasons for this was that there was an absence of adequate monitoring arrangements. We see that on page 2, which is 1460_0001. You see there was an absence of monitoring arrangements in place to ensure that this activity was followed.
What was that number again?
Now, if you just look about 2/3 of the way down the page, do you see the sentence, there was an absence of monitoring arrangements in place to ensure that this
Yes.
activity was followed?
Yes.
And what AMP said it was going to do, and we go to page 4, which is _003, was to put in place detailed processes relating to the adjustment of additional fees when a client's servicing rights are surrendered back to AMP-FP under a bowler arrangement. You see that?
Yes.
And ensure relevant staff receive training on the new procedures.
Mm.
again, just because it's being recorded, you'll need to
Yes.
say yes or no. And then you see the third thing was to put into place monitoring controls in our risk and control system covering compliance with the above-mentioned process.
Yes.
And you're obviously aware of this document, you've looked at it, you've exhibited it to your statement. Have you gone back to try to understand why since 2000, or whether and to what extent since 2009 any of those three things occurred?
I wasn't obviously in the business for a lot of that period of time, but that said, we've obviously had other similar breaches since then. I believe in 2013 and 2015, so this has occurred on a number of occasions. What we have done in more recent times is implemented a number of reviews to try and investigate, to put improvements into place in relation to these types of controls.
We should be clear about this. This problem has been occurring continuously at AMP since 2009, hasn't it?
Yes, that's correct.
And my question was, have you gone back to look at the extent to which there was an attempt to do any of these three things?
No,
Okay.
not specifically on those, no.
All right. That statement suggests that AMP only discovered or realised that ring fencing was occurring after it started investigating the 90-day exception. Do you agree?
I think that's correct, yes.
And we know from that chain of emails we looked at in mid-November 2016 that that was untrue. They'd already identified ring fencing before the letter sent on the 23rd of November
Yes.
2016. You agree?
Yes.
And in that respect, then, even this last breach notice was also false or misleading.
Yes, I think this is the one we discussed yesterday.
I don't think we did discuss whether it was false or misleading, but we may have referred to it.
I thought I could recall suggesting that the language in that was incorrect.
I see. Well, in any event, by my count, this is the 20th false or misleading
Yes.
statement made by AMP
Yes.
to ASIC. Thank you.
There was an absence of monitoring activities, which on one hand AMP said it was going to do to ASIC, for example, training for staff in new procedures. But it was different from what they actually did. The issues had been occurring since 2009, and AMP acknowledged that on at least 20 occasions they made false and misleading statements to ASIC about potential breaches. And worse, the Royal Commission revealed today that AMP's law firm, Clayton Utz, removed outgoing Chief Executive Craig Miller's name from a draft of a critical report about the business. So once again, we see the cultural norms in financial services driving poor behaviour, which may bolster profits but at the expense of their customers, and there is an apparent willingness to avoid the issues with the regulators. This is shameful but not surprising. So we see mismanagement again and failure of regulation, and we suspect we're going to see a lot more of the same in the days ahead. Frankly, I'm not surprised because the cultural norms we see displayed here are precisely the same as those observed in the previous lending-related hearings. The quantum of change required within our financial services organisations is profound, and I also believe the scope of the Royal Commission should be expanded to include the role and function of our regulators. Multiple failures are clearly costing households dear, but then the companies seem willing to cop the settlements and move on without applying root cause analysis and fixing the problems. This is not acceptable behaviour in my book, and it's well below community expectations. If you liked what you saw here today, please do like the post and leave a comment. If you've already subscribed, thanks, I really appreciate your support. If you have not yet done so, please do subscribe to get alerts to new posts. I'm Martin North, Principal of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.